Good morning, hello and welcome to a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Nigel and Surabhi. Morning, guys.
Good morning, Prashant. Good morning, Nigel. Nigel's wearing semi-green, or should I say teal. That's one cue. Prashant looks pretty happy in shades of, pink, or should we say peach. And for me, I think the biggest cue, guys, is that it's Friday. But of course, there's a lot more that we need to talk about.
Mix all three colors, you probably get green. Right?
Prashant, normally we talk about the Friday rager, right?
Yeah.
There's no bigger rager than who we have in our midst.
Just need to sleep. Just need to sleep. But Prashant, take it off.
We'll get to that, Surabhi, in a bit. But it's a good morning, right?
Yeah.
It's a Friday, and on top of that, global markets are supportive. So I think that's the starting point. So let me just quickly run you through a few things to watch out for. Equity markets moved up last night despite, and I say despite, a rise in yields and a rise in dollar as well. Sometimes markets just move on. I remember saying this around the time of when the Adani news flow around Hindenburg, etc., broke, that the intensity with which the market will react to the same data point again and again reduces because the markets are well aware that this is happening. Well, how much more can you react, fall or rise? And I think something similar may be at work with the US as well. So equities came up a little bit. By the way, both the S&P and the NASDAQ were up 0.7%. The S&P once again, for the second time this week, defended the 200-day moving average, and it closed slightly above it. Now get to the rates market, right? So the US 10-year now is comfortably above the 4% mark. We closed at, I think, 4.06 or something. We're at about 0.54 right now. But it pulled back a little bit from the highs, just a tad little bit, 2 or 3 basis points off the highs. But it's a strong close. The dollar index is just under the 105 level. It hit a high of 105.18. So maybe the market is, sort of reading into these small pullbacks of the highs. By the way, you just look at day-on-day close, the dollar index ended about 0.4% up, not down. So this is still strong, but equity markets saw a little bit of relief starting to come through. It's not as if data is yielding as well. I mean, we had the initial jobless claims number which came through, which once again showed that the labor market in the US is tight. We get the jobs report next Friday, which of course is the big number. This entire turnaround in the US market started with the last jobs data, and we get the fresh jobs data next Friday. And if initial jobless claims are any indication, it's likely to be tight once again. The question is this, right? Across the rates market, things seem to be very oversold. You look at the 2-year, the 5-year, the 10-year, the 30-year bond tenors, all are deeply oversold. And that is the hope, technically speaking, which could limit further big upside. So, I would say a pullback is due as well. We'll see. Timing is the tough thing with these things, but it's possible one day we wake up with a 10, 12 basis point pullback in yields for no reason other than the fact that they've gone too much in one way without a pause. Market remains very data dependent in the US. The ISM, the US ISM number, services number is later today, and the services inflation has been the problem. So I think that becomes an important one. Now come to the market here, right? So the takeaway from the US is not bad. It's not unambiguously positive, but it's not bad. It's okay. The market, the SGX is indicating a positive start, a higher start, which will get us to yesterday's high, which is that number, 17,467 or so is what the 460 or so is what the SGX Nifty is indicating in terms of an open, and that is the high point of yesterday's green candle becomes the first resistance which the market needs to take out. So 17,467 is the first level. Further resistance comes in at the retracement of the entire fall, the 6 or 7 day fall, which stands at about 17,600 and then 17,700. The exact numbers are on your screen, 591 and 695, but 17,600 and 17,700 are the other resistances beyond that. Support, of course, comes in at 17,255, which is the level you want to defend, which should not break if these upsides have to materialize. Bank Nifty closed at 40,390. There's not very much change there. The resistance comes in at retracements of the fall, which is at 4790 and then 41,070 for the banks. And of course, for banks, the positive, at the margin, the positive which has happened, of course, is the fact that a large foreign investor has come in as a buyer into the Adani Group stocks. The money doesn't go to the company, the money goes to the promoters, which means that perhaps there is a bit of deleveraging coming. And on the other side of the equation are banks, right? SBI and the like. So Keep an eye on the banks and Bank Nifty consequently. Recent low of 40,073 is important, should not be broken on the downside. And of course, the big one is 39,600, but that's just some distance away. I don't think that comes into play today. So go with 40,073 as a stop, as a pivot. If you're trading, which should not be broken, is a low 2 days back for the Nifty Bank as well. So as I said, it's not an adversarial picture globally speaking. You're looking at green, at least on equity indices, and SGX is indicative of a positive start as well. Surabhi, hi.
Hi, Prashant. Yes, positive to the extent of about 0.5%, 0.6%, at least as of now. I think critical for us always is, can you hold on to the
Yes.
opening pop? I think that's been the biggest problem with the market. We'll get our answers. Prashant, just to add, I completely take your point that on technicals, the market needed to move higher, and that's what it did yesterday, despite where the bond yields are. But if you just go back to fundamentals, I was looking at commentary. Raphael Bostic, the Atlanta Fed president, he said two things yesterday. The market chose to read into what it felt was more positive, the equity market. He went on to say that rates would need to go higher and remain elevated well into 2024. That was the first statement. Then he followed that commentary up by saying that he is in the camp that is pushing for a 25 basis points rate hike, not 50 basis points. Basically, he was indicating that the Fed needs to be a little more measured. The market latched on to that, okay, you'll hike rates, but at least one of the governors believes that it should be 25 basis points. That's the mindset of the market. It wanted to move higher after just intense pressure on the downside for so long. That's one. But that doesn't take away from the fact that data is still supporting rate hikes rather than a rate pause, whether you're looking at the Eurozone or you're looking at the US. In US, we had the jobless claims data, and jobless claims fell more than expected, 190,000. Move over to the Eurozone. There, the inflation number, though it's lower than January at 8.5%, it was still higher than estimates. Estimates were saying 8.2%. Look at core inflation, that's still rising month on month. So, in real sense, the data is still supporting a lot of the hawks out there, though, as Prashant's saying on technicals, just purely on technicals, the market needed some relief, and it literally latched onto that when it had the opportunity. Back home here, the big question that we'll be asking a lot of the experts as we go along is whether the Adani overhang, at least that one big factor, whether that's completely out of the market now. We've seen two big sort of events take place yesterday. One is what the Supreme Court order literally said, because now it's finite, it's time-bound. 2 months, and SEBI needs to come out with its report and submit that to the panel. And second, obviously, the developments that happened with respect to the block deal, the serious money that the promoters have managed to raise, 15,400 odd crores. And I guess, Prashant, I think a lot of the chatter now is going to be about GQG, this entity, their background. I mean, they're pretty large. We're talking almost $100 billion in assets that they're managing. They're listed in Australia. The man behind this entity, Rajiv Jain, has been in the equity markets. He's been managing money for 20 odd years. So I think there's going to be a lot of chatter about how much confidence can you take from the fact that it's this entity that's pumped in that money? That will definitely be dominating, mind space. Talk about the FIIs. Yesterday's numbers are obviously skewed because you had these blocks happening for over 15,400 crores. Net numbers positive. DIs were also positive to the extent of about 2,000. So that's what we have. But I think net, Nigel, as we're getting into the start, at least it's more positive than negative. And the bulls will hope that it's not a flash in the pan, as we saw in the middle of the week.
Well, that's right. Surabhi, yesterday, weekly expiry played out in favor of the bears.
Yes, yes.
But today, in fact, the SGX Nifty is suggesting a big uptake. And we're going to start off above that 200 DMA odd. So that's a perfect scenario that makes it for a freaky Friday. It can swing any which ways. And for me, the biggest factor will be the Nifty Bank. Because this big US fund, going ahead and buying a large stake from the Adani promoters, is it enough to fire up the Nifty Bank? Remember, the Nifty Bank took the hardest hit post this, this entire Adani fiasco that did break up. Now, the Nifty Bank yesterday, you would say, hey, you're a little disappointed because it ended under pressure. Until midway through the trading session, well, it was trying to hold one end up. But towards the end of the trade, well, it ended at the low point of the day. Just to, related to cricketing terms, you had Pujara yesterday was playing a good knock. But unfortunately, we didn't put in enough runs, right? So till midday yesterday, the Nifty Bank was doing fine, but then it gave away all that advantage. But not too worried over there, because there was unwinding of long positions that we saw. The open interest was lower. The Nifty Bank ended with a cut-off close to around 300 points odd. What did the FIs do? They unwound some long positions, and it appears they unwound long positions on the Nifty Bank itself. 8,000 long contracts, they got unwound. The previous trading session, they added 8,000 odd. All of that got unwound. and they continue to remain net short. Close to 85% of their positioning is on the short side. If we
85%, that's still 85% net short.
And we can hold above that 200 DMA, that's what could be the big trigger. Because then you have a short covering bounce that could be due. If we can hold on to this big gap up that we're looking at. On the option side, 17,400 call, 17,300 put. Well, both of them were very, very active. So let's plug in the numbers itself out there. You know, on the Nifty, the levels you're looking at is close to around 17,400, which is the 200 DMA out there. Just going by the 17,400 call writing that we're seeing, they are looking to defend 17,450 to 17,500. But first stop is around 200 DMA. So you want to hold about those levels. Recent low earlier this week was 17,255. So that's your support zone. But the Nifty band, that's the vital factor today. And there was some writing at around the 40,500 call. Close to around 270 rupees is the premium. So you plug in the 300 rupees with the 40,500 odd, you get your resistance zone of around 40,800. So that's a very, very important mark. And the recent low becomes support. Short point, SGX Nifty suggesting a good start. That'll be a thumbs up. Watch the first star. If we can hold on to those levels, we could be in for a bit of a short squeeze today. That's predominantly if the Nifty bank can bat it out and play a good innings today.
All right, Nigel. So it's a higher start, 100 points higher, almost exactly at yesterday's high. You know, can we build on top of that is the question, which we will try and figure out. Well, before we get into the show, let's quickly tell you what's lined up in the first half hour of the show. We get you updates from markets across the globe. Cameron Brand of VPFR Global will tell us which way flows are going. So that's the global setup. And later, our research team will bring you CNBC-TV18's list of top 10 stocks for the day. At about 8:30 this morning, we'll do a quick fundamental check with Nishal Maheshwari on Central Broking. We'll discuss, of course, the Adani news flow and much more.
All right, let's move on to the equity call of the morning, and we do have one coming in. This is from Bernstein. On equities, Rupal Agarwal of Bernstein says, in recent conversations, many investors in India indicated a preference towards GARP stocks, that's growth at reasonable price, or stocks with growth at a reasonable price. The fundamental thought process is to pick high growth companies as there is scarcity of growth, however, not paying up significant premium, hence the need for GARP. This also solves for the rich valuation concern within Indian equities. Previously, they had highlighted that tactically this is not the best time to add exposure to growth stocks, as a macro slowdown or recession is not the best environment for growth names to do well. And even the valuation earnings support for these names looks weak.
Well, let's get you some money market views as well. Bhaskar Panda of HDFC Bank says U.S. initial jobless claims data has reinforced the belief that U.S. employment scene is still robust, which could mean the Fed pushing for higher rates if this trend continues. He says this has pushed U.S. yields and thus the dollar index higher. He adds reopening of China is Asia positive, hence the Asia ex-Japan pack could do better. Given this backdrop and the fact that the USD INR pair has been recently capped at 83 to $1 levels, Bhaskar sees consolidation for the time being. He expects the dollar INR pair to trade in a range of between 82.3 to 82.5 to $1.
And on bonds, Bhaskar Panda of HDFC Bank says the yields have been trading higher, tracking global markets, but consolidation below 7.5% in the 10-year yield is expected. Hence, he expects the 10-year benchmark to trade in a range of 7.4 to 7.45% for now.
Well, we have a lot of stock-specific action to track for you, and we'll get to that in just a bit in our special Top 10 segment. We're obviously looking at the Adani Group stocks, Adani Enterprises, Adani Green, Adani Ports, Adani Transmission, all of them. And in fact, you have GAIL, Mahindra & Mahindra Financial, Mastech, Natco Pharma, and Bharat Forge. Their stocks on the back of positive news flow. However, we got a disclosure late last night on Olympic Pharma, so that one should react negatively to that piece of news.
Okay, well, we have Cameron Brand, Director of